Hey everybody, today we're going to step into the cryptoverse. We have Benjamin Cowan here, and he's going to give us an insight into his risk metric, which has proven over time to give an extraordinary edge in the markets, helping people decide when they want to take profits, when they would like to accumulate. Benjamin is going to go ahead and share with us this edge that everyone will be able to greatly benefit from. Benjamin, thanks for joining us today.
Yeah, thanks for having me, Jordan. And I mean, it was a pleasure to have you on my channel a few weeks ago. I know everyone loved seeing your perspective on the market. Should I just go ahead and jump right in?
Oh yeah, let's get into it. Describe
Yeah,
what
sure.
we're looking at here.
Yeah. So I have this thing. I've made this risk metric. I made this one back in 2019, and it was sort of like the second iteration of it. The first iteration, it didn't perform quite as well, and then I created a new one to sort of try to understand where are cycle bottoms, cycle tops, or at the very least, local bottoms and local tops, right? And so I created the risk metric around this point, right over here, after the 14K move. And I had previous versions of the risk metric before this one, but this one specifically I created back in late 2019. And the idea is when you're trading Bitcoin, you want to be buying it when it's historically low risk in the market and selling it when it's historically high risk. So what you're looking at here is just the price of Bitcoin on a logarithmic scale versus time, and it's color coded by the risk metric. And this risk metric specifically does account for diminishing returns. And the whole idea was that, well, if we factor in diminishing returns, can it give us an edge? And back earlier this year, back in March and April, I was looking at the risk metric and I was like, look, I mean, we're at the 0.9 to 1 risk band, right? And this is one of those things where, I love talking about cycle theory and whatnot. And a lot of people know my views on that. But at the end of the day, I only react to what the market does, right? Like if it goes up to these high risk levels, then no matter what I thought was going to happen, I take profits anyways. Or if it dumps down to low risk levels, then no matter what I thought was going to happen, I start aggressively buying, right? With everything I can, basically.
I mean, what Benjamin is saying here is also it's fun to put out theories and expectations of what we see happening and believe it happening. But whether or not this particular, I'll call it cycle, were to peak out earlier or later, Benjamin is trying to sell it when it becomes overvalued, whether or not it lengthened out or actually, peaked maybe even sometime at the end of the year. If he sees the risk matrix showing that it's overvalued, well, he's looking to take profits then. Right.
Right. Well, it sort of goes back to like 2020, late 2020. Like I was not expecting a move to 64K. By April. I know you were very much on board with that type of a move that early on, and I wasn't. And when it happened, I was like, all right, well, I didn't think this was going to happen by any stretch of the imagination. I did not think we were going to go to 64K that quickly. But because we did go to 64K that quickly, I decided to take some profits. And there's actually some method to the madness. This shows the risk as on the secondary y-axis. Okay, so it takes the color out, and then you can sort of see, you can more easily quantify it here on the secondary y-axis. So, back in Q4 of 2020, we were like in this range, right? Like we were this little white blurb right here. Mm-hmm. And at the time, I did not think we were going to go to the 0.9 risk level by April. Like I certainly did not think that. And we did, right? We did. So what I specifically do to navigate it is I take profits on the way up, but I weight those profits so that most of them are taken at the higher risk bands if we reach them. Okay. So for instance, you could do something like this. This is what I do with Bitcoin. I buy it anytime it's below 0.5 risk. I don't really care what cycle theory says. I don't care where we are, what we're doing. If it's below 0.5 risk, I just buy it, and I don't really care. And you can see that this drop after this move to the 0.9 risk band up here, the drop took us back down to this level. So it just allows for more reaccumulation. And right now we've actually recently left it again. If we were to drop a few $1,000s, we'd be right back below 0.5 risk. So the whole idea is anytime Bitcoin is below 0.5 risk, it is a gift, right? It's a gift, and it's a time to accumulate Bitcoin. Forget about the volatility in the short term is my thinking, and just accumulate. Because if you don't, and if you are always waiting for lower prices, what if they never materialize, right? Like, think about all the bears that are calling for 10K Bitcoin. I don't think they're right, but like, if they had just said, well, they could be wrong, and they had accumulated Bitcoin at higher risk levels because they said, you know what, they're not going to be super deterministic and they're going to do it anyways, they'll be much better off. Now, rather than buying Bitcoin like they should have at 30K or 40K or 50K, now it's, 56K and whatnot, and they're still hoping for it to drop back down, but it just simply may never do that, So that's the whole idea, is to come up a method, a strategy, right? And you just stick to it.
And
So
it seems like this offers the individual the opportunity to develop their own strategy within this matrix. For example, maybe some people, as price trades below the 0.5, they might want to start accumulating. And then the lower it goes down, for example, to a 0.3, maybe their position, their buy-ins are bigger. And even if it gets down as far as 0.2, is that how that works? Or does this open up the ability to customize a little bit?
Right. Yeah. So what I do is I call it like dynamic DCA. So like, let's imagine you're DCAing X into the market. Let's say you do like $100 a week, right? You just put $100 a week into Bitcoin if it's between 0.4 to 0.5 risk. So that's essentially what I do, right? Just say X is that variable amount. If it goes down to the 0.3 to 0.4 risk band, I do 2X. So I try to double it up. And then the further it goes down, I do 3X, 4X, and 5X, right? So, I mean, it can be hard, and at certain times you end up leaving some stable coins on the table, right? Because you just, you want to always keep some in case it goes down. But I would argue that having some stable coins is always a good thing, because it does allow you to, to sort of buy the dip. That's the idea, right? You dynamic DCA, you certainly want to be buying when it's at these higher risk levels, like 0.4 to 0.5, because it might not go down any further. Like, look at 2013. Look at what 2013 did. It went down to 0.3 or so. But imagine if someone had waited for it to get to 0.1 or 0.2, it just simply would have never happened. And by the time it did happen, it would have been after another parabolic rally, right?
Which, cycle awareness might offer a little bit of a opportunity to offer an edge in that as well. Understanding, well, during the bull market phases, maybe, when it comes down to 0.5, I'm actually, accumulating a little bit more, things like that. Ben, I don't, before you continue further, I think something really important needs to be said here. A lot of people who enter the space, they get really excited, and maybe without thinking about a strategy and or a plan and how they're going to execute that plan, they kind of just go. This takes a little bit of thought and pre-planning to kind of work out in advance what you're going to do and when you're going to do it. I think that's missing from the space, and I think it's critically important for success.
Yeah, I agree. And I mean, the same thing goes with what you're doing on your channel. And I mean, I love the play-by-plays and stuff that you give people, and how you measure the cycle from. I think that the most important thing is that everyone needs a plan, right? Yeah. If you go into it without a plan, you're just gonna get absolutely wrecked, right? You're gonna sell into fear, and then you're gonna buy the greed, and you're gonna be doing the opposite of what you should be doing. Yeah, but the great thing about this is it can actually be further customized. Some people might want to buy it up to 0.6 risk, right? Or 0.7. They might just say, you know what? Like, I want to be riskier than Ben. Like, he's way too conservative. He's only buying up to 0.5 risk. Like, why not buy up to 0.6? Why not buy up to 0.7? And there are people that do that. And you can see there's certainly different strategies. There's strategies where you maybe buy up to 0.5. You don't do anything between, say, 0.5 and 0.7. You just kind of like let it ride for a little bit. And then you maybe take profits when it gets up into this region. Maybe you do something like this. I know there's a few people that do this strategy, which I don't like. I can understand why people do this strategy, but you certainly miss out on a lot, right? Like, if you only ever buy below 0.2 risk, like the last time you would have bought would have been back in March of 2020, right? Okay. Now, if you had just gone at 100% into the market, right, that would have worked out extremely well. And then it went all the way up here. The problem is if you sold everything up here, like, what happens if it doesn't come back down to this region until, after another parabolic move? So that's the one downside of this strategy. But again, there are people that prefer these types of strategies. Because
That sounds like
it's
a
just,
good conservative strategy, long-term strategy, maybe for someone who's, maybe a little bit older. Maybe they're already
right,
retired. Yeah.
right. I mean, if you look at the strategy, the one thing you can say is they're not really losing money doing it, right? Like
They're just not
they
efficient.
might,
Yeah.
right, yeah. But this, I mean, this is just another strategy, right? I mean, and so there's some people that do this strategy, right? They like buy up to 0.5 risk and they only sell it above 0.9.
Okay.
And hey, look, it's a strategy. It's sort of like a YOLO type of strategy, where hey, maybe it works out, maybe it doesn't. I typically recommend if you
Well,
haven't already, I mean, sorry, do you have a
that
question?
could leave someone open for almost, let's call it, getting hurt, whereas maybe the cycle could peak and they never got to sell their Bitcoin. Is that
Right.
possible?
Yeah. Yeah, and that's why I think that for people playing the long game, you gotta consider taking some profits. I think above 0.8 risk if you haven't already,
Oh, yeah.
just because there's just no guarantees as to how high it can go. And I mean, this the risk metric, it's not like perfect or anything. For instance, back in April, or it predicted the highest the risk metric reached was at 0.94 risk at 58K. All right, so at $58,000. So I mean, I thought we were getting really close, right? I didn't know exactly where it was. I mean, it could have gone to 70K. I think the highest it could have gone at the time was like 75K, maybe, if it had gone to all the way up to one. I was, when it went to 58K, and then I'd sold off. By that point, I'd sold off 87% of my Bitcoin stack. That was at least in long-term capital gains territory. I was like, all right, what's going on? Because then it went to 61K, right? And then it went to 64K. And I was like, oh man, like what's going on? Like it's not coming back down. Fortunately, it did come back down.
Well, could you imagine how much, I mean, Benjamin created this. Could you understand, could you imagine his understanding? It's important, whatever strategy you're using and implemented, that you spend the time with it to understand it, because as you are actually executing in real time, right? You're never getting
Right.
the top tick or the bottom tick that you buy. You want to have the confidence and fortitude and belief to be able to stick with it. Otherwise, there's no point in it. Actually, there's no point in you even speculating in the markets.
Yeah, I mean, like I did not sell exactly at 64K, but I took profits that I'm happy with. I actually, a lot of those profits ended up going into things like Ethereum, because we know, I mean, as everyone knows by this point, if they don't, Ethereum usually rallies after Bitcoin, right? So that was sort of one strategy, is the Ethereum rally, where it goes up like 2x in 2 weeks after Bitcoin makes a move. So hopefully it'll do that again this time, right? Like
Now, I
hopefully
know
it's
this
gonna
is something that you would get into more intricate details with those inside, or who have privy to this information inside your premium list. But are you taking profits, beginning taking profits as price gets to 0.8 and above, and how does that work a little bit?
Yeah, it sort of depends. Last time I was a lot more conservative, or I was more conservative in taking profits, because, and I'm meaning I took more profits, and the reason was because I'd been accumulating Bitcoin forever, right? Like, I mean, we had the 2018 bear market, right? We had the 2019 market, which didn't, I mean, it went to 14K, then back down. We had 2020, where we spent a lot of time below 10K and only started above 10K really, in like Q3, Q4 timeframe. So I'd been accumulating Bitcoin for the cycle for years and years and years, So I was a little bit more, I definitely was taking more profits. This time I'll be, what I'm thinking is the best strategy is to give myself some wiggle room,
You talk
and
this
to
out.
also,
Do you talk this out with the people that you're on your list,
right, yeah,
going through these
yeah.
different
So
scenarios with them?
yeah, so I try to outline different scenarios for people that are younger, for people that are older, but I think also for people that are in different circumstances, like someone who is young and is looking to make a lot of money, they're going to want to take on more risk than someone who might already have a lot of money, who might want to protect that money rather than look at it like life-changing money, right? Like there's a difference between like creating wealth and preserving wealth. But I do think it makes a lot of sense to, to have a wristband where you're not doing anything, like at least one, where you're just sort of sitting back and you're not buying or selling, but you're just you're just letting it go, right? Because the problem is, if you don't do that, then what do? Like, do you buy it every time it goes slightly below 0.5 and then sell it every time it goes slightly above, right? Like that, you just keep trading back and forth every other day if it's constantly flirting around that price. That doesn't really make a whole lot of sense. So you really should give yourself like a band or something here, a wristband, where you sit back, you let it do its thing, and then once it comes up to the higher risk levels, you take profits. Now, look, I mean, like Bitcoin right now, we know Q4 is usually when it shines. So I think taking profits out of Bitcoin to your altcoins at this phase would be somewhat disrespectful to your Bitcoin position. It would not make a whole lot of sense to me to do that at this phase of the cycle. But look, like, what if in December, like let's imagine a scenario where in December, let's suppose Bitcoin's trading for like, I don't know, 150K or something. Let's just say it's 150K, which I don't think it'll be that high, but let's just suppose it is, right? I didn't think it was going to go to 64K by April, and it did. So let's just suppose it goes to 150K in 2 months. And we're up here at, say, like the 0.8, 0.9 risk bands. Then what I would be looking to do is I'd be looking to take profits. I'd be putting them in stable coins, Ethereum, and smaller amounts into altcoins. Like, look, altcoins are great and you can make money on them, but a lot of altcoins come and go, right? A lot of them come and go, and you have to be really, really careful. So that's sort of how I look at it. It's more like it's just a lot of if-then statements. Like, if Bitcoin goes to the high risk levels, then I'll take profits. If Bitcoin does not go to the high risk levels, then I just keep accumulating until it does go to high risk levels, right? So that's
ultimately you have a plan in place, you have a thesis, but you're following the market and you're following price, and that ultimately is what you make decisions off of.
Right. I think it's more important how we react to them. I mean, accumulate when it makes sense to accumulate, and then when it goes up, make sure you react to what happens. Don't just watch it come and go, right?
Good stuff.
That's the biggest thing. Here's an interesting chart on the price versus risk, which I think is an interesting way to look at it, and it's actually color coded by time.
What is this? I'm not familiar with this. Could you explain it to me?
Yeah, so basically everyone plots things on like a time series, or most people are plotting things like on a time series. And I know you were recently even talking about looking at things like by blocks, right, rather than always doing it by time series. But most people are so accustomed to looking at things by time series. This one does not include time except in color. It's just plotting the price of Bitcoin versus the risk level. So the great thing about this is, like, you can see that at at some of these lower risk levels, it hit 0.1 risk, multiple times. Or let's just say, like, 0.3 risk. It hit it when it was $1, when the price of Bitcoin was $1. It hit it years later when it was $10. It hit it years later when it was $100. It hit it later when it was a few $100s, then a few $1,000s. So the point is that eventually 0.3 risk will be, like maybe $50,000 or $70,000, and that will be the time to accumulate, or to really go big on it. But that time probably won't happen this year. Like maybe when Bitcoin is at I mean, I don't know exactly where the next bottom will be. I have speculations as to where it's going to be, but it just goes to show you why time is important, because once upon a time, the price of Bitcoin at $1 was 0.3 risk, and today 0.3 risk would probably be closer to, like, I don't remember exactly what it is, but you're probably talking somewhere around $30,000, right? So the point is to say is eventually the risk levels, we know they adjust with time, right?
Yeah.
Like, they adjust with time, and the longer it takes us to rally, I think ultimately the higher we will go. Like, that's sort of what I think. So, like, if we rally over the next couple of months and then we're done, like, and that's it, that's all she wrote for the cycle, then I don't think it'll go quite as high as it could go if, let's say, it kicked the can down the road, a couple more months or 3 more months or whatever, or 6 more months, whatever it is. So that's why I always say, like, time is on our side, because it allows the risk levels to adjust. It allows the market to get accustomed to the new normal and then accept higher prices, if that makes sense.
I understand what you're saying. Yeah. And I view it similar in the consolidation this particular year has been a lot longer than it was, for example, in the 2017 bull market. right? So that
Right.
might make it the price a little more volatile, volatile to the upside. The longer in
Right.
all markets, the longer something consolidates is what you're saying, the more room it has
Right.
to expand. Yeah.
Yeah, I mean, like, look at all this consolidation we had over here. Look, I mean, it just shot up. I mean,
Mhm.
that's sort of the thing behind Bitcoin is right. Like during these phases, this is the uncool phase, right? To be in Bitcoin, this is where people, say like, why are you buying Bitcoin? But that's actually that's where all the real money is made, right? Like the real money is made buying in the bear market.
Well, that's when this is showing you the ideal time to buy each time. This is when the very few times you're seeing the risk metric at a very low reading, right? When no one wants
Right.
anything to do with it. Yeah.
Yeah, like I mean, I remember watching it live when it went to 0.12 risk, and I mean, I'm not gonna lie, like at the time,
Yeah.
I mean, I was loading up, but I was also getting a lot of people saying, "Hey, is it gonna break?" Like, are we gonna go? Are we going off the table here? Fortunately, we didn't. Um, so far since I've made it, the lowest it ever has gone since I made it in 2019 was 0.12, and then the highest was 0.94. So that's sort of the bounds that it's been in so far. It hasn't made it. It didn't go below 0.1 yet. It hasn't been above 0.95 yet. It made it to 0.94. So it's not perfect, right? It's not perfect at telling you exactly, but it sort of gives you the window of like a few weeks of say, hey, like this is we're near a major sell a selling point, right? And can I share another chart really quick, actually?
Oh yeah.
Um, yeah, so it sort of goes into this thing of when I was talking about these types of charts. When I talk about market cycle ROI and whatnot, and a lot of people thought that I was only like back over here. I was very adamant that I was like, all right, I think we're ahead of schedule. I think we need to have like a lull in the market. And I think everyone thought that I was saying that just because we were ahead of schedule, or at least, sorry, just because we were ahead of the last cycle's ROI, right? Which I did not expect us to be ahead of last cycle for that long. I did not expect that to happen,
Right.
but it did happen. But that was one reason. But the main reason wasn't because of that. It was because of this, right? It was because we were all the way up here, and I'm just like, well, every other time historically where we've been at these high risk levels, we've always sold off before trending higher. So that was sort of why I thought that back then. It wasn't just because of this chart. It was also because of the risk levels sort of saying, and honestly too. I mean, I sold off a lot of my Bitcoin, so I was kind of biased and wanted to see it go down so that I could buy it back.
Well, great awareness, because you're looking at, for example, it was I think the first week of January or late December where I said, look, watch out if we have a double wave, I called it. And for me, price would have had to come too far too fast. And the way that I was viewing it, it never hit. And I said it would have to reach like ridiculous levels, like between 80 and $100,000. And your risk matrix gave you a different lens, a different vantage point to say why price is not coming that high. Look, the risk level is showing you that it indeed has come too far too quick. And this is a place, if you're interested in taking profits, now's the time to do it. So it's
right.
really,
But that was the thing where like I also, again, I did not the risk metric. It's more so reactionary to how you react to it, because I did not think we were going to go to those I didn't think we were going to go to 60K, like that quickly, but we did, and that's why you always have to be ready for it, right? So like to give you an idea, I mean, the risk levels right now, I mean, for us to go to these high risk levels, we need to go well into the six figures. We need to go above $100,000 and 140, 150, 160K. But again, they're dynamic. They change with time. Like 6 months from now, they'll be even higher than they are today. So that's why I say, like, generally speaking, time is on our side in the grand scheme of the cycle, because the longer it takes us to ultimately make that parabolic move, whether it happens this year, next year, whenever, we should be able to, to go up higher. So, I mean, we'll see. We'll certainly see what happens if we make that move sooner rather than later.
so it's fair to say one of the this like what is it? All models are useful, right? Some are better
All
than
models
others.
are wrong. Some are useful.
Yeah, and it's important to have that self-awareness of where the risk is for your model. And Ben, the way that I view this is like something that's super like a sure shot. you're going to do well following this, no matter what market condition or circumstances you're in. It might not be the most efficient, but it's gonna be way more effective than the majority of other models out there. The one risk that you would watch out for is if you said this is built for diminishing returns. So the one risk that you would have to watch out for is if we didn't see that, just be aware of, again, you can't go wrong within the parameters of this. As far as I can't imagine a different market outperforming the performance that you're gonna receive here or anything like that. But those who are just want to be aware of everything, the one risk would be that if you didn't see diminishing returns. Fair is
right. Right. And there are two ways I account for that. Like that potential event from I account for that potentially happening. One way is I don't sell any Bitcoin usually that I haven't been holding for at least 1 year, just for tax reasons. And so I sort of have like a stack that I always sort of have, even if it does go up to the higher risk levels. So if that happens, and then the other way to help with that is to, instead of just selling Bitcoin at say a certain price when it reaches say 0.9 risk, you can just put in like a stop loss or like a trailing stop or something like that. Like for instance, when it was like, at 58K, when the risk metric, when it hit, 0.94 risk, I just put in a stop loss, right? And it was triggered. I mean, I did end up selling it, but if it hadn't pulled back, and it just kept going up, then I would have just continued to move the stop loss up. So that's sort of what I'm looking to do.
The other side of that is, in the same breath, if for whatever reason there was no diminishing returns this particular cycle, that does not mean that this is not super effective, because as you move further in, further out, we're going to see, as the adoption curves flattens out, for sure you're going to see diminishing returns, and this model will always be super effective. So I think that's important for everyone to have that perspective, that even if like no one could get the exact bottom, no one could get the exact top, and you shouldn't have those type of expectations, but you want to understand something fully. And I think in watching you present here, Ben, that there's a couple of things that are really important. Number one, your interaction with the members that you're working closely with, showing them whatever is happening at that particular time, what your thoughts and views are. Not saying, well, here's what I think is going to happen, but what is happening is what you're focused in on. And that type of perspective, that type of insight, that type of edge is invaluable. The other thing is, this is actually a very long-term tool that is going to be able to help people for a long time to come. Really.
Yeah. And look, I would love for us to not have diminishing returns. Like
this is not about that right now, so that's all good either way.
Yeah, I would absolutely love that.
we all would. Yeah. And even if we have diminishing returns and Bitcoin goes into six figures, and as long as everyone's able to take profit at the right time, everyone should be really happy, right?
Right. Yeah. I guess the real question is, like, because we were talking about, I guess it'll be interesting to see how high it ultimately ends up going. That's for sure. And I imagine, the height at which it goes could certainly help us tweak models for the future. I guess.
That's important.
Yeah.
And from what this looks like using diminishing returns, this is, a price like $180,000 would be well within range here. Is that correct? You would be 0.9.
Yeah, I mean, I think that I think it's also important to talk about like what's like even the definition. But I mean, Bitcoin, I think it could still go to 200K. Like I don't think it still can reach those levels. 300K is getting closer, is getting much closer to the last cycle's returns. Because it did, again, from the cycle bottom, it did about 100x. From the halving, I think it did about 30x or something. I'd say 200, it still seems doable. 300, it's getting pretty high. Like 300 is getting pretty high. I also imagine too that when we talk about diminishing returns, we're also just referring to the last cycle. Like, I don't think very many people think it's going to say outperform 2 cycles ago.
Well,
This,
yeah, that's a good distinction to make. And I think that's
yeah.
100% correct. People are talking just in relation to the previous cycle.
Right, just the last cycle. Because I think for us to not for us to outperform 2 cycles ago, we'd have to go over $1 million.
Yeah,
Yeah, and I
outside of
don't.
a hyper Bitcoinization event. That's
Right.
not,
Yeah. I don't see that happening. But yeah, I think it's mainly, and hey, look, we've been keeping pace much more than I thought we would
yeah.
with that last cycle. And I think the question now is, are we sort of gearing up for that move, right? Like that leg. And if we are, then I'll see how high we go. I mean, if we make it to 300K, then we're certainly giving the last cycle a run for its money, for sure.
Then if I guess the one thing that I personally want to protect myself from is if we don't see that type of action at the end of the cycle, whenever it is, which we've seen in the previous cycles, but
Right.
that's not to say that we do this time,
Right.
and if we don't, and what will that look like? Will the risk metric be giving a type of signal that we
Yeah.
are getting fulfilled?
Well, it probably would do something similar as to what it did last time, where it might say, hey, we're at the 0.9 to 1 risk band. And let's say it hits 0.94 risk at like 160K. But then a week later, it goes to 170K and then 190K, but it just does it slowly. So that's sort of the one caveat is, and that's why it did not get the peak exactly, because again, it thought that the peak was at 58K, but we know that wasn't the peak, right? It went to at least the local top. I'm not talking about a market cycle top. The local top back in April was 64K. So that's sort of the downside is if it has one of those rounded tops,
Yeah.
rather than say like a blow off top, then there's probably going to be a little bit more uncertainty in exactly where that top is if it does something like that. And actually, it's been doing stuff like that recently a lot. I mean, like 2019 was, I mean, obviously no one's considering 2019 a crazy parabolic move. Yeah, but
that would be the worry though.
Those...
Something like that occurring at this cycle top, that would be the most difficult, let's say, price action for myself or anyone, I believe, to get right. And that's what we need to be aware of. Yeah.
Yeah, I mean, it basically, like, what if we just if we repeat from October of 2020 until April of 2021 and we just copy paste that to today? Like, I mean, yeah, that would certainly be interesting to navigate. Like if it just does one of those things again where maybe it goes up to like 200K, but rather than selling off immediately, what if it just kind of chills at 200K for a month, That would certainly be interesting, and it would probably have people wondering, like, like should they be loading back up for a move to 300K, or is it about to go back down to 100K? So I guess we'll
a lot of people will be thinking this is the last cycle, and maybe loading up, and then if the rug got pulled, that would be a surprise. There are certain circumstances that could be very difficult to navigate, and I think that's what everyone should be focused in on. To make sure that they always be aware of what your risk is. It's very important.
Right. Yeah, for sure. I mean, I think we have to pay attention to these parabolic moves because they can happen really quickly if.
And I know what you would say. You'd be like, well, that's all right. I took profit in March and April, and I didn't get to sell yet. But hey, listen, this thing goes back to undervalued levels. I'm just loading up more and I'm just waiting longer.
Right.
That's the thing on your side. Yeah.
Right. That's the thing with Bitcoin. Like, and that's what I've told people. I was like, look, I don't think 64K is the peak. Like, I really don't. I think we will go much higher. But hey, there's got to be one universe in the multiverse where maybe I'm wrong, right? And
you never know, right?
Yeah. Like, what if something crazy happens that we just can't predict and it goes down? Even in that situation, you're gonna wish you had majority Bitcoin, right, over say 100% alts. But even in that situation, I think it just provides more opportunity to accumulate, and that's how you navigate. I mean, this entire chart is only like 11 years. It's not even that long.
And Ben, I know that I'm Bitcoin centric, and most of the viewers watching this probably are, but not all. Does this work on all different crypto assets, this type of risk metric? And it does,
but for the other ones, I don't account for diminishing returns. And so Basically my rule there is just assume that every cycle, the peak is at least one risk band below where it was the prior cycle. So like Ethereum made it to the 0.91 risk band last cycle, therefore assume this cycle it can only go up to 0.8 to 0.9 risk, and then next cycle it can only go up to 0.7 to 0.8. And the reason I have that is because they're you know, for Bitcoin we had so much data that we had to work with, right? And to understand like what it's doing, you know, the type of diminishing returns that it's seeing and whatnot. With things like Ethereum, we just simply don't know, right? Like we don't know what it's going to do. We've only have one full cycle behind us. And even then, even in that cycle, it didn't even start at the bottom, because January 2015 was the Bitcoin bottom, but Ethereum didn't launch until later that year. So we don't have a ton of data for those assets. So you have to be a lot more careful and probably take profits sooner, because they don't account for diminishing returns.
Very interesting, Ben. Very, very interesting stuff. Thanks for taking the time to share with us. And
Yeah,
again,
thanks for having me.
Yeah, we look forward to more, especially as we get towards you know, at a time frame where this gets difficult. You know, having the vantage point of multiple sources is just a huge edge. We're all in this together at the end of the day, and the more we work together, the better for everyone.